Hi, this is Kirk with Forex Strategy Secrets. Now, we're going to talk about different ways of entering the market and placing trades for maximum profit. And there are several different ways of looking at entering, managing, and exiting trades. One is to add several lots, like right here would be a good entry signal. So the one management system would be to add several lots. Many people talk about adding 3 lots. Then I've heard many people say after 20 pips you close one of the lots, another 20 pips you close one of the lots, and you put your stop at the break-even point and let the other one run and see what happens. Well, first of all, see what happens causes me some concern, because that means they don't know really what how the market's reacting or how to read the market. But let's say that the person that talks like this goes down here and about 120 pips they decide they're going to close because it came down and retraced. 120 pips they actually close the trade. So they got 120 on one, 20 on another one, 40 on another. So now they're about 180 pips on their whole trade. Not a bad trade. This is on a 4-hour chart. Now another way of looking at it is to add 1 lot on when the market is most risky. It's most risky when you don't know what the trend is and don't know if it's going to be moving or not. And so you add 1 lot on, and then as the market turns and comes out of a retracement, that is one of the best places to enter. So at that point you would put your stop loss right in this area, and you see the entry point would be right here. So the worst case scenario is if you added 2 more lots right here and they came back up against you, you would be 80 pips into that trade plus the original 89 pips. So at worst case, by combining the whole thing together, you'd have a small profit of about 10 pips. But you have an idea as to how the market's going to move. So what we like to do is, if a trade moves like that and it takes us out, then we can add on heavy again, because now we know that the market's going. But let's say we left the trade on and added on to it right here. We added 2 more lots here, so we have our total of 3 lots. It goes down about another 80 pips, so another 160 pips there, plus the original of about, this is going to round it to 200, 360 pips in going to that trade. But what if you'd been closed out at the 9 pips up here and just re-entered at 2 lots right here and then closed it out for 80? You'd have 160, 170. You're still right at about the same point as if you had gone in and scaled out of the trade. When you use the scale out method, that says you don't know how to read the market, and it also says that you're putting the most amount of your capital at risk rather than putting a little bit of exposure. Once it gets in your favor, then and moves heavily, then you can add more to it, and you're actually protecting some of the risk because of your profit on the previous move, and that will in many cases give you a larger amount of pips per the trade. So in summary, you put the least amount of exposure to the market when there's the greatest amount of risk, and then once the market gets moving and head retracement is headed back in your direction again, then add on a little heavier. We proposed 2 lots possibly, but you might add 2, 3, or 4 additional lots on, and then that would even greatly increase your profits, and the risk at that point is even less because the trend is actually formed and is moving in a direction. The other way is to add a whole bunch of risk and just take it out a little bit at a time. Yes, you're getting some profits, but the chance of making the big money is not going to be there.